Okay, let's just dive right in. We are unpacking the pretty wild financial story around cbdMD, Inc. That's ticker YCBD.
Right. This is all about their fiscal year 2025 earnings call, which happened after hours on December 19th.
And it's just a fascinating situation. You've got this microcap stock trying to pull off a complete reset operationally, financially, all while, standing in the middle of a regulatory hurricane.
That's the perfect way to put it. Our whole mission today is really to figure out why. Why did management present this genuinely positive turnaround story? And it was positive.
Oh, absolutely. The cost discipline was there.
Exactly. Cost discipline, margin expansion, and yet the market just hammered them, wiped out over 21% of the stock's value in a single day.
So we have to separate what the company's doing right internally from this massive external risk that's hanging over them.
That's the puzzle, and it's a big one.
All right, so let's ground ourselves in the data first. The operational numbers. Management kept calling FY25 a reset year, and the results, well, they really reflect that. It was about stabilization, not some kind of explosive growth.
That's right. I mean, if you just look at the top line, the results were pretty modest. It's all about holding steady while they clean house.
So what were the numbers?
Q4 revenue came in at about $4.7 million. It's a slight increase year over year, like 3.6%.
And for the full year?
For the full year, revenue was $19.1 million. So that's basically flat. Actually, a tiny dip from $19.5 million the year before. And, we're not really focused on GAAP EPS here.
No, because the real story is how they methodically just shrank that loss.
That's it. And that shrinking loss profile is where you can really see the discipline shine through. I mean, if you look at the margins, that's where they made their money back, literally.
Talk to me about the margins.
Well, the gross margin figures are an excellent signal of efficiency. In Q4, they jumped up to 58.8%.
That's a huge jump.
It's a strong 490 basis point improvement year over year. And for the full year, the margin was even higher at 62.4%.
Okay, wait. A nearly 500 basis point jump in a single quarter? That doesn't happen by accident, right? That's a structural change?
It signals operational maturity. It means they successfully rationalized their inventory. They basically dumped the lower margin products, that's SKU rationalization, and just focused on making their most profitable items more efficiently.
So they're selling better stuff through smarter channels.
Precisely. It's the operational clarity they promised in this whole reset.
And, okay, when you couple that high margin focus with some really aggressive cost control, you get serious bottom line improvement, even if the top line is kind of flat.
You do. The full year operating loss improved by a huge $1.15 million.
Yeah.
That shrinks the GAAP loss to negative $2.16 million compared to over $3.3 million the year before.
And what about the non-GAAP number?
Even better. The non-GAAP adjusted loss from operations, that improved by almost $1 million for the year. It's down to just negative $346,000. They just systematically stripped $1.2 million out of SG&A costs.
So we've got a disciplined cost cutter who's cleaning up the books and optimizing the product mix. The narrative so far is management is building a really strong foundation.
Yes, but cutting costs only gets you so far if you can't finance the future. And that's why the changes to the balance sheet are just so critical here.
Okay, let's do a deep dive there, because that turnaround is frankly the most impressive part of this whole thing. It's the foundation for any growth they might have.
It really is. Let's start with working capital.
Hit me.
The change is transformative. cbdMD ended the fiscal year with $2.3 million in cash. But the key number is working capital. They went from a very concerning negative $2.2 million in FY24 to $3.4 million in positive working capital this year.
Okay, for anyone listening who maybe isn't buried in financial statements all day, why is that shift from negative to positive so fundamental for a small company like this?
Positive working capital is survival. It's the difference between having cash to pay your suppliers to make payroll versus just constantly scrambling. When you're negative, you're living quarter to quarter. You lose credibility.
You can't plan for any kind of growth.
Not at all. So moving to 3.4 million positive, that unlocks immediate stability. It gives them better terms with suppliers, and it proves to any potential partners that they are finally a going concern in an operational sense.
And they pulled that off by tackling a huge debt overhang that had been plaguing them for years.
Exactly. They just methodically cleaned up their capital structure. They eliminated over $7 million in annual accrued preferred dividend obligations.
And those were just piling up.
Piling up. And by converting them to preferred equity, they just wiped a huge short-term liability off the books. It frees up immense flexibility.
And cleaning that up let them hit a major governance milestone that was kind of hanging over their head.
Right. They got back into compliance with the NYSE American exchange. That removes a huge listing overhang. I mean, if you're struggling with listing compliance, institutional investors, they won't even look at you. So this was a big signal.
And just to be safe, even after all this, they went and secured more capital recently.
They did. After the period ended, they closed another $2.25 million in preferred financing and, I think very wisely, secured a $20 million equity line of credit.
Now, that equity line, you have to be careful with dilution.
You have to be very mindful of dilution, but it gives them crucial flexibility to handle volatility. And management said this fortified balance sheet makes them a much more attractive partner and gives them the wherewithal to, quote, weather regulatory uncertainty.
Which brings us to the big question. The internal house is in order. So where are they putting this new capital to actually grow the business? Let's pivot to the commercial side.
Yeah, the commercial momentum shows this real tug of war between their old business and their new focus. Their bread and butter is still direct-to-consumer, DTC sales.
Still the biggest piece of the pie.
Oh, yeah, it's 77% of their total sales, but it saw a 6% year-over-year decline in the fourth quarter.
A 6% drop in 77% of your business. That's not small. How do they explain that?
They pointed to a consumer shift towards hemp beverages, which, conveniently, is exactly where they've pivoted their new investment.
Ah, so that explains the flip side.
The positive flip side, yeah. The wholesale channel saw strong Q4 growth, up 25% year over year, and that was driven almost entirely by their new beverage brand, Oasis.
So tell me about Oasis. Can a beverage brand really make up for a decline in their huge e-commerce business? Is this the new growth engine?
That is the million-dollar question. I mean, Oasis is positioned as this functional alcohol alternative social drink. It's now in 9 states. Big ones, too, like North Carolina, Florida, and Texas.
And management is putting their money where their mouth is.
They are. They signaled they are prioritizing working capital investment right into scaling Oasis. They believe this high-growth beverage segment is the future. They're basically betting that this new product can eventually outgrow their legacy business.
It's a bold bet.
Yeah.
Especially when any kind of growth is completely secondary to the regulatory world they live in. And speaking of which, just before the call, Washington delivered a classic case of regulatory whiplash.
It was an impossible situation. I mean, on one hand, they got a massive piece of good news from the federal government. The day before the call, the White House issues an executive order.
The EO.
EO, yeah. And it directs agencies to modernize cannabis policy. But crucially, it specifically supports exploring Medicare reimbursement for legal, full-spectrum, hemp-derived CBD.
Okay, we need to stop here because the potential scale of this is just, it's staggering. Management talked about the numbers.
They did. And the numbers are almost hard to believe. So management says Medicare covers 60 million consumers. They cited a potential for up to $500 per year in reimbursement for compliant CBD products if this all moves forward.
So if you do the math on that.
You run that multiplication, and it suggests a potential $30 billion market increase in demand for quality compliant products like theirs.
30 billion with a B. This is a company that just did 19 million in revenue for the year.
Yeah.
That's over 1,500 times their current sales. This isn't just a catalyst. It's a universe-altering event if it happens.
It is. And the bridge to get from 19 million to a $30 billion market is compliance. It's partnership. They believe their science-driven, compliant approach positions them perfectly to capture that demand if, and it's a huge if, the regulatory path opens up.
So the clean balance sheet, the positive working capital, that's all about making them a trustworthy partner for big healthcare distributors should that day come.
That's the strategic ambition. But standing directly opposite that $30 billion carrot from the White House is a big legislative stick from Congress.
Two completely different signals at the same time.
It's the conflicts that just tank the stock.
Yeah.
You have to contrast that positive EO with this highly restrictive hemp language that was in the HR 5371 legislation, which passed just in November.
And what's the core threat in that new language?
It's all about specific THC limits. And if those really restrictive definitions stand, management said it could potentially wipe out a huge chunk of the current industry. It's an existential threat to many CBD businesses.
So they're caught between a potential $30 billion boom and a potential industry-wide bust.
Exactly. They admitted they're operating carefully, running contingency plans, and just hoping their high-quality standards will protect them no matter what happens.
So, okay, let's recap. We've got a company with a proven operational reset, a solid balance sheet, a new high-growth product, and a $30 billion catalyst. But it's all completely overshadowed by this immediate existential threat from Congress. It's an impossible spot to be in.
And that leads us right to the market's reaction. Why did investors just dump the stock? Down over 21% on high volume, despite a great operational report.
It's the overhang. It has to be.
It's the cold, hard reality of the audit. That's what the institutional investors saw. Despite every single victory we just talked about, the company had to explicitly flag a going concern explanatory paragraph in their audit opinion. It's right there in the 10K filing.
Okay, for our listeners, let's just be really clear. What does a going concern risk disclosure actually mean in plain English?
It means the auditor is legally required to flash a giant red warning light. They're saying, we don't know if this company will be around in 12 months unless something significant changes.
It's not saying they will fail.
No, it's not a guarantee of failure, but it's a statement of material risk that they might. And in the investment world, especially for compliance desks at big funds, that's a trigger.
It's an automatic sell for a lot of funds.
It is. It means no matter how good your gross margin looks or how clean your working capital is, the psychological hurdle to buy or even hold the stock is it's almost insurmountable until that's gone. It turns the investment from a fundamental story into a binary bet on survival.
And that one paragraph just overshadowed everything else on the call.
Completely. They also confirmed the fully diluted share count, about 8.9 million shares, plus the preferreds. And maybe most telling, they gave no formal financial guidance for next year, no revenue, no EPS ranges.
Which just confirms the focus is on survival and navigating the storm, not predicting growth.
Stabilize first, then you can forecast.
Right. And that structure of risk versus reward brings us to our final segment. Now remember, everything we discuss here is based on public info from that call. It's purely for educational purposes. We are not recommending you buy, sell, or hold anything.
Absolutely. Yeah. This is emphatically not financial advice.
Okay, so given the intense volatility, the regulatory tension, and that explicit audit risk, here's an outrageous but plausible trade idea based purely on everything we just discussed.
Well, the core thesis here is a highly leveraged bet on regulatory clarity. The operational cleanup provides a floor, a pretty solid one, but the ceiling. That's all about that $30 billion Medicare catalyst.
The trade. You go long YCBD common stock. You're betting aggressively that the White House EO wins out, that regulatory clarity happens, and that Medicare opportunity starts to materialize. But you can't just own it naked, not with this risk.
So you have to hedge.
You have to hedge. So simultaneously, you short an industry-wide ETF, one that holds a big, broad basket of other hemp and cannabis companies.
And what's the thinking behind that specific hedge?
The thesis is that YCBD has set itself up to be the compliant, high-margin, quality producer. They're a pure bet on the federal policy working out. If the White House momentum wins and overrides that restrictive congressional language, YCBD wins disproportionately because they're ready.
And if it goes the other way?
If the restrictive language stands, the broader, maybe less compliant industry, the one reflected in that ETF, gets wiped out. So your gains on the short position help hedge the losses you take on YCBD.
So you're essentially betting that the White House policy will win out over the congressional pitfalls, and that YCBD can turn that reimbursement potential into actual demand before that going concern risk becomes a full-blown crisis.
You're betting that policy resolution is the only thing that matters right now.
That perfectly sums up the dual narrative here. You have a successful internal reset positive working capital, clean balance sheet, great margin set against this massive external regulatory risk, which is then compounded by the auditor's warning.
The market is focused on the floor, not the ceiling.
Completely. They're discounting any kind of durable earnings power because of that explicit risk to continuity. The management team has, they've done everything right on the operational side, but they can't control Washington, D.C.
So the final question for our listeners.
The real question for you is this. How much is that potential $30 billion market catalyst truly worth today when you weigh it against the explicit risk of continuity, flagged in flashing red lights by the company's own auditors? That huge gap between potential and reality. That's where all the risk and all the volatility lives right now.